And we're live.
Good morning, everybody. Welcome to another edition of MSATP TV. Joining us today is Jim Dawson with Miles Stockbridge. Jim's here to talk to us about the state's recent enactment of dissolving your business without having to pay the fees and everything else to file articles of dissolution. So, Jim, why don't you explain a little bit to us about what's going on with that?
Okay. Well, this is something that's not really new. It's been in the works for quite a while. So what happened this year, the Department of Assessments and Taxation asked the legislature to introduce the bill on its behalf. So House Bill 647 was a departmental bill, and it was endorsed by the governor. And it finally passed this year after numerous attempts. This is I guess the first time a similar bill was introduced was back in 2017. And there were actually companion bills filed in the House and Senate in 17. The Senate bill passed the Senate, but the House bill got caught up in the Economic Matters Committee and didn't get out. And that was, like I said, 2017. In 18, 19, and 20, similar bills were also introduced. And in 18 and 19, they met the same fate, unfavorable report from the Economic Matters Committee. And 2020, in the shortened session, it went to the House Rules Committee and just languished there until the end of the session. And this year it actually got some legs and was passed unanimously by both the House and the Senate, and then was signed into law by Governor Hogan. So it's actually Chapter 142 of the Acts of 2021. And what this act does is eliminates the processing fees for documents filed with the Department of Assessments and Taxation to dissolve, cancel, or terminate an entity, whether it's a foreign entity or a domestic entity, foreign being non-Maryland. This act took effect on July 1st of this year, and it eliminates both the $100 filing fee or the $25 filing fee. It's really a processing fee for filing the articles of cancellation, articles of dissolution, or if you're a foreign entity, the application of termination. Surprisingly, this, according to the fiscal note, this bill would reduce general fund revenues by around $880,000. And that's just for these terminations, which seems to be a lot of money for the state. But the rationale behind this and the reason that the department wanted to eliminate these fees is more from the standpoint of what happens if an organization doesn't properly dissolve. So if an organization just ceases to exist and doesn't file their personal property tax returns, they don't file the proper articles of dissolution, cancellation, or termination, the Department of Assessments and Taxation is still required to do an assessment of the personal property if an entity had filed a prior return indicating that they had property and the department wasn't properly notified either of the dissolution, termination, cancellation, or that the property was transferred. If the property is transferred, then the assessment's not made. If the department is of the belief that that property is still within the company or the entity, then it's required to certify the assessments to the local jurisdictions. And then the local jurisdictions will issue a tax bill and attempt to collect the taxes that were assessed. SDAT believed that, the burden of filing the articles of cancellation, the financial burden, was too great on a lot of these businesses that were dissolving for financial reasons. you have a lot of companies that are going out of business just because they haven't been able to succeed. So they really have the finances. And the department saw that as a barrier to them going through and properly dissolving or terminating the entity. So they had this legislation introduced to make it easier for those entities to file and to encourage those entities to file the articles of dissolution, termination, or cancellation, and thereby close things out on the books of the department, so the department's not incurring all these additional costs and the time it takes to go through a forfeiture provision or proceedings, which can take up to 20 months, and for the local governments to avoid the process of having to go through issuing the tax bills and then trying to collect the taxes that are assessed, or working with the entities or the prior owners of the entities to get things corrected on the books of the assessments and taxation in the local jurisdictions. So it's the elimination of the fee is really to encourage entities to stay in compliance, avoid the forfeiture process, and file the articles of dissolution, cancellation, or termination.
Okay. When the entity has been forfeited and it's still operational, but they just didn't file the personal property tax returns, and they want to dissolve the business years later, do they have to get themselves reinstated back into good standing before they can file the articles of dissolution at that point in time? Or does the state allow them to file the articles of dissolution and just close it out now?
Now, in order to file articles of dissolution, you have to be in good standing. So all your property tax returns have to be filed, taxes have to be paid, and you must be in good standing in order to file the articles of dissolution. So if an organization wanted to dissolve, they would have to file those back year taxes and pay the taxes that were due.
So it's not going to
filing fee and the late filing penalties.
Okay. So it's not like this new bill that came on is going to be able or allow the state to clean up all those forfeitures that are sitting out there.
No.
In the world.
The only thing this bill did, and if you look at it, it's a very, I think it's 2 pages, and most of that is like the wherefore clauses of it just talks about the different sections that are amended and a little bit of a brief summary of what the intent of the bill is. But the bill only eliminates the filing fee for the articles of dissolution, removes the processing fee for filings that will dissolve, terminate, or cancel an entity. And then there's a blanket provision that they added that basically says there are no fees for filing documents to dissolve, cancel, or terminate an entity within the state.
Okay.
So everything else in the law remained the same. This particular bill did not change any of the current procedures with regard to coming into compliance or getting reinstated or anything involving forfeitures.
Okay. Yeah, I was hoping it would help to clean up some of the forfeitures that are out there and make the names available again.
Yeah. Now, if an entity has been forfeited and they reported that they did not have any business personal property, then they don't need to go through the process of dissolving. I mean, that entity is already terminated for state purposes. And because there was no property, the department's not going through the assessment process, not certifying the assessments to the local jurisdictions, and the local jurisdictions aren't billing the entities for taxes and trying to collect. So you don't, if there's no business personal property and the entity's forfeited, then it really doesn't need to do anything.
Okay. All right. Is there any words of wisdom that you can give us for directing our clients on how to resolve these issues?
Well, I mean, first and foremost, encourage them to stay in compliance so they don't get into a situation where they're facing forfeiture. There are any number of reasons that an entity could face forfeiture. And most people think of the non-filing of the personal property tax returns and not paying the $300. But they can also be forfeited if they're not in compliance with provisions under the Department of Labor or the Comptroller's Office. So the Comptroller and Department of Labor can also certify to the Department of Assessments and Taxation that an entity is not in compliance with their laws, and an entity can be forfeited for that reason.
Ah, I didn't know that. That's interesting information there.
Yes, and if you're not in good standing, then it's important to try to get back into good standing, because an entity, for example, let's say an entity is going through an IRS audit, and the status that an entity has been forfeited, that is no longer a corporation or no longer a legal entity, then the individual owners could be deemed to be either partners or sole practitioners, sole proprietors, and they could be personally liable for any of the taxes that may be due as a result of the IRS audit. And the other thing is, if you're going into court, if the entity has been forfeited, you may not have standing as an entity to even challenge the suit if a suit is brought against you. And if you're the plaintiff, you may not be able to bring an action because the entity legally doesn't exist.
Okay. So we should work with all of our clients to make sure that their status is that they are all in good standing and that all the paperwork is all caught up and taken care of to protect them on a corporate level.
Yes. Mm-hmm. Yeah, it's a little bit of business hygiene. You know, a lot of people think, well, you know, it's $300 plus each year we haven't in compliance. You have the penalty provisions that can be up to $500 a year for the late filing. You have interest. You have the legal costs or the accounting costs, tax return preparation costs. Plus, you have the local taxes that have to be paid. So it can be a huge financial hit to the company. But if the company wants to remain in existence, then it should get into compliance and stay in compliance. Yes, it's going to be a financial hit, but in the long run, you can avoid some of the unnecessary litigation or hardships down the road. Unless, of course, the entity is fully dissolved and, you know, not dissolved, but forfeited, you're not in operation, and you don't need to have that business entity any longer, then the answer may be a little different. But if it's an ongoing business, they should get into compliance.
Okay. Any other words of wisdom for us?
There were a couple questions that were submitted in advance.
Okay.
One of the questions was, individual said that they had a client that was not in good standing. They had not filed their 2008 personal property tax return or paid the fee, but had filed and paid ever since. But it wasn't indicated in the question whether or not the entity had been forfeited for not filing the 2018 or 2008 return. If it had been, but has filed everything else since then, it can go in, file the 2008 return, pay the tax, pay the penalty, which will be assessed. You can't prepay the penalty. It's assessed after the return is filed and processed. And then the entity can then, if it's a corporation, file articles of revival. If it's an LLC, it would file articles of reinstatement. If it's a foreign entity, it would file either the requalification or re-registration forms. And that would require them to, if they have property in a local jurisdiction, paying the local jurisdiction tax, getting a tax clearance certificate from the local jurisdiction, and attaching that to the reinstatement documents and filing that with the department. Now, if it was forfeited for another reason, either the Department of Labor or Comptroller's Office, they'll still need to go to those agencies and get a clearance certificate and attach that to the revival documents. And when it's submitted to the department, otherwise the Department of Assessments and Taxation will not accept the forms. They won't process them.
Okay.
And the one question was, and you kind of asked this, whether there's a grandfather clause that can allow people to start new, or kind of give them a refresh. And the answer to that is no, as for the reasons we talked about earlier.
Okay. Well, Jim, thank you very much for joining us today. I appreciate it.
Yeah, it's a pleasure.
And we'll have to get together again and have you back again.
I would welcome that invitation.
Okay. Well, thank you very much.
You're welcome, Bill. Thank you very much. Appreciate the invitation to join you today.
Okay. Bye.